All right, hey, welcome. So let's talk about buying a house. It's a huge deal, the American dream. You spend months saving up, maybe even years saving up. You scroll through Zillow until your thumbs are numb, you tour houses with character, shag carpet on the bathroom walls, a weirdly small door you have to crouch through, but then you find it, the one. You get the loan, you sign a mountain of paperwork. Seriously, my writer's room has fewer pages, and you get the keys. It's amazing. Then you open your first mortgage statement and see a charge labeled PMI. Wait, what? I thought I bought a house, not a streaming service I didn't sign up for. Huh? It feels like paying for extra guacamole you didn't order. Okay, let's get into it. What is this stuff? First, there's the big umbrella term, mortgage insurance, or MI. Think of it like the general category late-night TV shows. Then, under that big umbrella, you have a few different types. The most famous one, private mortgage insurance, or PMI. That's the Tonight Show of mortgage insurance. Everyone's heard of it. There are other kinds, government-backed loans. FHA loans have their own version, but PMI is the one most people with conventional loans run into. So, for today, when I say mortgage insurance, I'm mostly talking about our buddy PMI. It's the star of our show. Here's the crazy part. The twist ending you see coming from a mile away. Mortgage insurance doesn't protect you. You're paying for it, but it's not for you. PMI actually protects the lender, the bank. It's their safety net. So, we've established that this whole PMI thing is triggered by your down payment. But why 20%? Is it magic? Did a wizard in a tall, pointy hat decree it thousands of years ago? Not quite, but it might as well be. In the world of mortgages, 20% is the golden ticket. It's the number that tells the lender, I'm serious. When you put 20% down, you have 20% equity from day one. Equity is the part you own. The rest belongs to the bank until you pay it off. It's like you and the bank co-own a giant pizza. Your down payment equals your slices. Putting down less than 20% is super common, especially for first-time buyers. Saving 20% is tough. In some cities, that's a sports car, or a lifetime supply of tacos. And I love tacos. PMI is actually helpful. It's a tool to get in with 3%, 5%, even 10% down. It opens the door to homeownership. The bank says, sure, less down, just pay for our insurance. Example, house price $400,000. 20% down is $80,000. That's a lot of cash. Put 5% down, $20,000. Get in sooner, but you'll likely pay PMI monthly. 20% is the dividing line. Those who pay PMI and those who don't. Not a lifetime membership, we'll cancel it later. Alright, so we've danced around this a little bit, but let's say it loud and clear. Who pays for PMI? Is it the seller? The bank? A mysterious wealthy benefactor? I wish. No. The person who pays for private mortgage insurance is you. Yes, you. The borrower. The homeowner. It gets tacked right onto your monthly mortgage payment, sitting there between your principal and interest. It's like having a third wheel on every date with your house. It just makes things a little more expensive. You're paying for an insurance policy that protects the bank. But that's how the system works. Think of it less as a penalty and more as the price of admission to get in sooner. Usually it's rolled into your mortgage. If P&I is $2,000 and PMI is $150, you pay $2,150 plus taxes and insurance. Some lenders offer lender-paid PMI. Sounds great, until you see the higher interest rate for the life of the loan. It's like a one-time fee versus paying a little extra forever. You gotta do the math. Either way, one way or another, it's coming from your pocket. Okay, let's talk numbers. The fun part. How much is this PMI gonna set you back? A cup of coffee a month? A second car payment? The answer is, it depends. The cost of PMI isn't a flat fee. It's a percentage of your loan amount. It changes with a few key factors. The main one, your credit score. The other, your down payment size. Better credit plus bigger down, sure's lower PMI. Person A, 760 plus credit, 15% down. Person B, 180 credit, 3% down. A pays less, B pays more, just like car insurance. PMI typically ranges from 0.5% to about 2% of the loan amount. 400K price, 5% down, 20K. Loan, 380K. At 1%, annual PMI 30 is 800, or about 317 month. That's a car payment, or a lot of pizza. with better credit or 10% down. Say 0.6% on a 360K loan, 2,000 earned in 60 year, about 180 month. Huge difference. Prep your credit. A little work now can save thousands later. Alright, you're paying for PMI every month. You see that charge and it taunts you. It's like a pop-up ad you can't close. Good news. No secret handshake, no code word, no game show. There are real ways to get rid of PMI. You're not stuck with it forever. The key is building equity in your home. Remember equity, the part you actually own, grow that. The Homeowners Protection Act says when your balance hits 78% of original value, your lender must terminate PMI automatically. On 400K original value, 78% is 312K. Once your loan hits that, poof, PMI gone. That happens with regular payments over time. Faster route. Request cancellation at 80% of original value. That 2% gap can be months or years saved. Hit 80%? Call your lender. Hey, I've hit the magic number. Time to drop PMI. Be current and have good payment history. If your home value climbed, ask for a new appraisal. If your balance is 80% of the new value, you can cancel PMI. Bought at 400K, loan now 380K. If value is 500K, that's 76%. Bingo. You may pay for the appraisal, but a few $100 to save thousands? Great trade. It's like finding a $20 in your old coat, except it's every month. So there you have it. The secret world of PMI unveiled. It's not so scary now, is it? It's just another piece of the home buying puzzle. Understanding what PMI is, why you pay it, and how to remove it puts you back in the driver's seat. You're the one with the map. For many, it's a bridge to homeownership sooner. It's a tool. Know how to use it. Homeownership is a marathon. There are hurdles. PMI might be one. Now you know the course. Get rid of PMI by paying down your mortgage, watching your home value, and being your own best advocate. Call your lender, ask questions, stay on it. Future you saving $100, $200 a month will thank you. Go out there with confidence. Do your research. You've got this. I'm Kris McCullough, Marine Corps veteran and mortgage loan officer with the KDM Team. Funding loans other lenders fear. We work in multiple states. Find me on Facebook, YouTube, Instagram, or at krismccullough.com. We're here to fund homes and build dreams.